Here, you see this is what essentially happens whenever a bullish breakout is happening, right? So now, if you look at this, you will see that this is a typical chart that every retail trader will draw. There's going to be a resistance line as soon as there's going to be a big green candle, which is also known as a bullish breakout. Now, usually, us as traders, we always look for a breakout with a volume confirmation. Can I have a yes if you all agree with me? That whenever we are looking for a breakout, we always look for a volume confirmation, right? That the volumes of the breakout should be higher. Now, although that is a correct way of looking at things, but you really need to understand how volume works to actually understand why entering after a breakout is never going to make sense for you. Let's understand this. Most retail traders will buy here at this point where my cursor is, thinking the price will increase even higher. Why? They think institutions or big players have entered here at this point. They see a big spike in volume, which is here, which further validates the fact that institutions were involved. Now, yes, it is true that institutions were involved in creating this breakout. It is absolutely true. But the problem here is if we will enter after the breakout, institutions may not want to buy more when the prices are already higher. That means institutions could probably have bought maybe somewhere here, maybe here, maybe here. And once the price has already reached the breakout level or it has already broken out of that range, institutions might stop buying. And if they stop buying, the price will not move higher. And that is exactly why 70 or 80% of the breakouts fail. So now, what's the logic here? For that to understand, you need to know that volume, what exactly is volume? Volume is nothing but the total number of transactions executed at any given point of time. So a transaction, as I already mentioned, is always going to involve a buyer and a seller. So without a seller, a buyer cannot buy. Without a buyer, a seller cannot sell. So whenever there is a big volume breakout and the volume bar is green or red in color, it doesn't mean that if the volume bar is green, there are more buyers, and if the volume bar is red, it doesn't mean there are more sellers. It simply means that there are a lot of transactions that happen, and you all know that for a transaction to happen, buyers and sellers both exist. That means when a lot of people bought here, a lot of people sold as well. And that's the reason retail traders are wrong. So, when large quantity is both bought and sold, if retail and institutions both bought here, then who sold? If you go by the retail trader's logic, this is the question that you should ask yourself. That if institutions are also buying here, if retail traders are also going to buy here, then who will sell? It doesn't add up, right? Let me help you understand how this exactly works step by step, and you will get a very good understanding of how exactly everything works. So let me just open my next schematic. Now I know you will see that okay, there are so many things written on the chart. It's overwhelming. Don't worry. Give me 2 or 3 minutes. I will explain all of those things to you. This is a very detailed, in-depth understanding of how order flow is really working, and I've tried to recreate an example of a breakout, right? So let's go step by step and understand this, right? So you've already understood that whenever a bullish breakout happens with volume, this is the trader's buy point, right? So this exactly is the buy point of the trader where this arrow is marked, right? Usually when traders buy over here, there are two things that they will do. Number one is place a stop loss order, which is somewhere mentioned over here. You can see I've circled it. That retail traders will usually punch in their stop loss below the retest area or below the resistance. So that's one which you have to remember, that retail traders, if they enter at the breakout, they will set a stop loss order. But let's rewind a bit. How did the price even reach here? Let's try to understand that. Before the breakout, one thing is very clear. This breakout was created by institutions. Now, most retail traders start their analysis after the breakout. Let's rewind and go back to the point on why and how this breakout was actually created. So, when you see that at this particular point I can make a trend line. So you can see that I can, simply join these dots and I can make a trend line. Now usually what happens is whenever the price is breaking below the trend line, what do you think retail traders do? Just give me a yes or a no answer. Like just give me an answer in the chat box. Whenever the price, let's say this is a trend line, right? Let's say this is a trend line, and as soon as the trend line starts to break, what is the first step that a retail trader does? They start short selling the stock. They feel that the stock has broken the trend line, so the stock will fall, and that's exactly what happens. When the trend line is formed, retail traders start selling. Why? A trendline break after a resistance tap is usually looked as a sign of rejection. Because retail traders are punching in their sell orders, this is the liquidity for institutions to place their buy orders. That means if retail traders would not have sold the stock at the trend line or below the trend line, institutions would have never got the opportunity to buy. So when retail traders start selling, someone is buying those stocks or someone is buying those shares. Institutions are the people who start buying. Now, why did the institutions buy? Is because they could see that retail traders are selling 10, 20, 30,000 shares, and because they are selling, institutions can plug in their buy orders and execute their transaction. So the first point, which is point A, this is where the first leg or the first part of institutional orders were executed. Now, if you have forgotten, I told you that institutions have a large order to place. I showed you a slide where I told you institutions are dependent on retail traders, point one. Point two was institutions always execute trades in a large quantity. And point three was institutions can never execute their entire quantity in one go. So now those three rules will be applicable here. So since institutions are dependent on retail traders, that's exactly the first thing where I told you that retail traders will sell below the trend line thinking that the prices will go down. Those sell orders give an opportunity for institutions to plug in their buy orders so that they can take this liquidity. And once that happens, institutions have divided their orders into three parts. Let's say the first part executes 70% of the orders, the other part executes 20%, and the last and the final part executes 10% of the orders. So this is the first leg, this is the second leg, this is the third leg. So this point over here is the first leg of institutional orders being executed precisely at this point. And because those orders are always going to be larger in number, meaning retail traders selling 30,000 shares at a break of a trend line, but institutions wanted to buy 70,000 shares. So since 70,000 is larger than 30,000, institutions will first take all the 30,000 shares because retail traders sold 30, institutions bought 30,000, prices will not move a lot. But now, when retail traders are done with their selling and institution buys another 40,000 shares, that is when the price starts to move because the demand exceeds the supply. When prices reach this point, this is where the second leg of the order starts to get executed and institutions push the price even higher. By the time the price reaches this point, which is the last and the third leg of the order, only the residual 10% of institutional orders are executed, and that is how this breakout candle is created. So now understand, the point at which retail traders were buying is the point where institutions were executing the last leg or the last part of their order. And this is the point where all retail traders are thinking, hey, this is the point where institutions are actually starting their buying. No. Institutions are not starting their buying here. Institutions started their buying somewhere here. They are probably ending their buying over here at this point. Now, as I also said, institutions always place larger orders, right? So this 70 plus 20 plus 10 could only be a small chunk of their original order. They might want to buy more shares, but at this point, they decided to only execute 1 lakh shares. Maybe, let's say, they wanted to buy another 1 lakh shares maybe later, but they did not find the liquidity, so they're only executing 100, 1 lakh shares, and then they're doing nothing. Now, at the point of the breakout, which is this point, if institutions stop their buying temporarily, what if institutions stop their buying temporarily? This will mean retail traders have bought, institutions have stopped buying. If institutions stop their buying, prices will not go up. And if prices will not go up, retail traders will start seeing the price to do something like this. Price will slowly and slowly come down because there is no buying that is happening, and the prices will naturally come down. When prices naturally start to come down, some breakout buyers start to feel the pain, and slowly they will start selling small quantity to get out of their breakout trade in a loss. When some of these traders keep selling, they need a buyer, otherwise they cannot sell. How many of you agree? Retail trader ने breakout के बाद buy कर लिया, right? So retail traders bought after the breakout. Now the price is not moving up. The price starts to come down a little. When the price starts to come down a little, some retail traders panic and they are like, I want to sell. I want to get out of the trade. But for them to get out of the trade, they need a buyer. How will they find a buyer? Institutions are now not buying. They're done with their buying. Retail traders have already bought after the breakout, so there is no buyer. If there is no buyer and someone wants to sell, the prices will come even lower. Imagine you want to sell something at 100 rupees. There is no one to buy at 100. Someone is willing to buy at 98. You will have to lower down the price, right? So like this, the prices start correcting a little bit like this. I'll just make my cursor red. This is the point that I'm talking about. The prices slowly and steadily start falling down, but institutions are not selling. They're neither buying, they're not selling. Retail traders are the only people who are selling in small quantity. Because retail traders are selling here and not institutions, the volumes will be very low when the prices come down. This is very important. If institutions were the people who sold at this point, the volumes at which the selling would happen will be higher. But since retail traders are the only people who are selling small quantity, and because of that the prices are coming down, you have to understand that there will be a point where the price will reach this area where there are all stop loss orders of retail traders waiting. All of these stop loss orders are nothing but sell orders, which is nothing but liquidity. So when the price will come to the retail stop loss area where all retail traders will be selling those 30,000-40,000 shares, institutions suddenly realize that these retail traders are willing to sell 30 or 40,000 shares. We anyway wanted to buy another 1 lakh shares. Let's buy here because we are getting that liquidity. So this becomes buy side liquidity for institutions. As retail stop losses get triggered, institutions punch in their buy orders, and because retail were selling 40,000, institution wanted to buy 100k, the price after reaching here will suddenly shoot up and then continue in its original direction. But the irony is, retail traders will be thrown out, they will be kicked out because their stop losses are triggered, and then the price moves up. So what exactly happens? Something like this happens. I'm just marking this on what is the final picture. The price goes up, retail traders buy here. Retail traders were expecting the prices to go up, but the prices continuously start falling down. When the price come to an area where all the stop loss orders of retail traders are executed, every retail trader on the buyer side is out. That's exactly where institutions punch in their order, and then this big green candle which you see over here appears, and then retail traders start thinking, bro, I entered the right stock in the right direction at the right price, but the market took me out, and